Okay, we're on to the inventory/sales study guide lecture part 2. So number 1, the two primary classes of transactions in the sales and collection cycle are sales and cash receipts. Those are the big ones that we're dealing with. For sales, the occurrence transaction-related audit objectives affects which of the following balance-related audit objectives existence. Do the sales actually exist? Number 3, analytical procedures are substantive tests, and if the results of the analytical procedures are favorable, the auditor would normally reduce the test of the detailed balance. So again, if you can rely more on those substantive analytical procedures, you can reduce the detailed test of balances that you'd be doing. Number 4, which of the following is a correct statement regarding analytical procedures? Auditors should also compare the results of their analytical procedures to budgets and industry trends. So when you're looking at what a normal allowance percent is, it would be good to look at what you had budgeted for, and also to look at what the industry does on average. So, a curtain company, what is their average allowance for doubtful accounts? Your cologne company, what's the average amount that people are not paying their bills? Because usually the market is pretty much the same. So it's good to compare to industry averages. And when you're looking at budgeted results, what did the company think it was going to be? And if there's a big variance, why was it different? Because the budget is what's actually approved by the board of directors or the board of trustees. So, it's usually a pretty good number that took a lot of time to come up with. So again, why is it different? Number 5, an auditor is comparing the write-off of uncollectible accounts as a percentage of total accounts receivable with the previous year. A possible misstatement this procedure could uncover is an overstatement or understatement of bad debt. So when you're looking at these amounts written off and looking at it compared with the previous year, you probably want some consistency in this number. Why would it be so inconsistent? So it's just a possible way to uncover these misstatements. Number 6 below are listed possible misstatements that could occur in the sales and collection cycle. Provide the analytical procedures that would be most useful in detecting the possible misstatements. So we have an overstatement of sales and accounts receivable. A procedure that could help this is comparing the gross margin with the previous year, and then compare sales by month, line by line, over time. So again, overstatement of sales and accounts receivable. Is the margin consistent? Are the sales pretty consistent by product? If not, why? This could be detecting an overstatement of sales. Uncollectible accounts receivable that have not been provided for, you're going to look at the bad debt expense as a percent of sales. Maybe you didn't book enough bad debt expense to cover these uncollectible accounts receivables that you have potentially sitting on the books. And then an overstatement of sales returns and allowances. Compare this as a percent of sales to the previous year. If you just haven't provided enough, then it's going to throw off your analytics when you're looking at a year-to-year comparison. So number 3, a listing of balances in the accounts receivable master file at the balance sheet date by total balance outstanding and by the amount of time the components parts have been outstanding is the age trial balance. This is what you've been looking at in your case study, that whole listing that shows who the customer is, how long the balance has been outstanding. I call it an accounts receivable aging report. Could call it an age trial balance. Same thing. Audit procedures designed to uncover credit sales made after the client's fiscal year end that relate to the current year being audited provide evidence for which of the following audit objectives this is cut off. You're concerned when the sale is made and if it was recorded in the right period. Cut-off misstatements occur either by fraud or error. It could be just an error in the whole processing or an intentional deceit. Number 8, which of the following is likely to be determined first when performing test of details for accounts receivable? Is B, the accounts receivable in the aged trial balance agreed to the related master file amounts and the total is correctly added and agrees to the general ledger. This is what you did. We didn't actually agree the sales price back to the master file, but know that that is a step that could be included in the process. Number 10, the most important test of details of balances to determine the existence of recorded accounts receivable is those confirmations. I mean, if they say that they have a customer that owes them money and you send them a confirmation, they say, yes, we do in fact owe them money, that's pretty likely that the accounts receivable does exist. Number 11, because of its central role in auditing of accounts receivable, which of the following would normally be one of the first items tested? Again, the trial balance, this is what the AR aging that you used for the majority of your testing when you did the AR case study. Number 12, confirmation of accounts receivable selected from the trial balance is the most common test of details of balances for the accuracy of accounts receivable. So again, these confirmations are also testing the accuracy. Is what they say the accounts receivable balance owed, is it accurate? Is the amount accurate? And of course it counts what it exists. So these confirmations are covering multi-assertions. So number 13, most tests of accounts receivables are based using what schedule? The accounts receivable. That's where most of the testing is going to be generated from. Number 15, a customer mails and records a check to a client for a payment of an unpaid account on December 30th. The client receives and records the amount on January 2nd. The records of the two organizations would be different on December 31st. This represents not a cutoff in the statement, just a timing difference. This is what you saw on the exceptions that you saw in your accounts receivable, an actual just exception. It was a timing difference. Number 17, when do most companies record sales, return, and allowances? It should be recorded during the accounting period in which the sale, the return has occurred. This is when you record those sales returns. But the allowance, this is a little bit worded funny because the allowance should be recorded in the period in which the sale occurred. So you're recording the reduction of the sale against the sales return and the allowance when the return occurs. But please remember, when you're booking the allowance for these sales returns, you would book it in the period that the sale occurred. Just kind of like when you're setting up an allowance for AR, it's not when you write it off, it's when the sale has been recorded that you think there's a possibility a percentage of your sales could be bad. Same thing with this, a percentage of your sales returns and allowances, you think, the sales are going to be returned as a percent of the total sale. And number 19, the most important aspect of evaluating the client's method of obtaining a reliable cutoff is to evaluate the controls around cutoff. What is your client doing? Are they aware of the cutoff issues? Do they keep track of those shipments before and after year end? Not just shipping out for sale, but don't forget from the inventory side, actually being shipped in as well. How might the auditor determine whether a client has limited rights to accounts receivable? You can review the minutes. This would tell if things are going to be pledged, and just inquire with the client. There's really not a whole lot more. I know we talked about in class where you're looking at those cash receipts too. So if a client of yours has pledged their accounts receivable, they're no longer getting the money to those accounts receivable. The money is going to the factor, so you wouldn't see money coming in. So this could lead to significantly aged accounts that are improperly sitting in accounts receivable because they don't have the rights to the accounts receivable any longer when that does happen. Number 26, a procedure to test for cash receipts cutoff error is to trace the recorded cash receipts to the deposit tickets on the bank statements of a different period. So, doing this cutoff between when the receipts have been made and the cutoff statements could help figure out if there is a cutoff error in the cash receipts. So again, when was the cash received? When did it hit the bank? Again, cutoff errors could happen. 26, a procedure to test for cash receipts cutoff error is to trace recorded cash receipts sorry, this is duplicate 1, so I have 2 26s there. I'm thinking I thought it was really important there, so sorry about that. You only just remember 1. Now discuss the audit procedures performed when testing the detailed tie-in objective for accounts receivable and explain why this objective is ordinarily tested before any of the objectives. So in testing the detailed tie-in for accounts receivable, the total column depicting the aging amounts are footed and the totals compared to the general ledger. So you've done that in your case. In addition, a sample of individual balances on the aged trial balance should be traced to supporting documents to verify the customer's name, balance, and proper aging. All right, number 1, which of the following is a principal weakness of using negative confirmations? The conclusions drawn from receiving no replies may not be correct. And we talked about this where, you're sending out these negative confirmations. How do you know that the person who received it actually even checked the balance and verified that it was accurate? And, I don't know if you've ever received one in the mail. I actually never have, but you might eventually get one from a bank wondering if this is the right balance that you have in your account. You might just throw it away thinking it's junk mail and you're not actually verifying the balance. So it is a weakness. A lot of firms don't use negative confirmations. It does give some, some assurance, but it's the positive confirmations that you're getting back that the client says, yes, we do have this accounts receivable balance and it is correct, or here is the error. So steer clear as much as you can from negative confirmations and focus on the positive confirmations where you're receiving them back. A type of positive confirmation known as a blank confirmation, it requests the recipient to fill in the amount. So sometimes, you have this blank one where they have to fill in the balance, or you give them one that already has the balance filled in, but there are 2 different types. Usually when I was sending out accounts receivable, I would fill in the balance or give the statement that they would have received last to say, is this correct, just to help with their ease of record keeping. Number 6, when should auditors not perform alternative procedures in testing the accounts receivable balance? And this is when customers do not receive negative confirmation. So if you don't receive a positive confirmation, you have to do these alternative procedures. You look at cash receipts. You might have to go back to the original sales order and shipping documentation to make sure that sale did in fact actually exist and is correct on the accounts receivable aging. It's incredibly time consuming, so you really hope that you get back all of your positive confirmations. Negative confirmations, though, if you don't get them back, you don't perform any alternative procedures. It is what it is. You actually don't want to get them back because if you do get them back, the way that negative confirmations are stated, that only send it back if there is an issue. In which case, if you receive a negative confirmation back, you probably would have to do alternative procedures then, but not when you don't receive one. Number 8, when positive confirmations are used, auditing standards require alternative procedures for confirmations not returned by customers. Which of the following would not be considered an alternative procedure? This is the sending out the second confirmation request. You would do that anyways. You're required to send out a second request. You would stamp on the positive confirmation that this is the second time you're requesting the information, hopefully to prompt the recipient to send it back because, you really need it back. But that's not considered an alternative procedure. Alternative procedures would, like I said, looking at the subsequent cash receipts, looking at the shipping documents, looking at the purchase order and the sales invoice. Those are alternative procedures. And believe me, they're time consuming and the client gets frustrated because they have to dig back through a lot of records to get this information for you. So again, you just hope that you get back those positive confirmations. Number 17, describe the differences between positive and negative confirmations. We've talked a lot about that. I do want you to know those differences. Number 18, discuss the alternative procedures an auditor can perform to test the existence objective for accounts receivable when customers have not returned their confirmation. So we've talked about that. Number 1 here, matching. So be familiar with each of these different terms and be able to match them to the appropriate places. And that's it for this chapter. Thank you for listening.